Good afternoon. My name is Professor Paul Moran, and I work for GBSB Global in Madrid. And I would like to welcome you to our webinar today on Facebook Live. And I'm just going to check with my colleague, Lisa, to see if you can hear me and to see if the screen is correct. Hi, Lisa. I'm live now, and I don't know if everybody has arrived to the webinar.
Yeah, so 21 listeners?
Yes, so I cannot see the listeners. Is that right? So I'm currently living in Madrid, and unfortunately, it is one of the places whereby there has been the most cases, and there is very severe lockdowns. And we can only go out for shopping or go to the pharmacy, and even the supermarkets are very cautious about their customers all have to arrive, and they give them special gloves, and they make sure that we have a distance between each person. And then obviously to buy the groceries, and then when we take them home, we have to clean them and wash them down with alcohol before we can eat, let's say, fruit or vegetables. So it is a very, very serious situation in Madrid, and the government is meeting today to see if they're going to extend the deadline. The current deadline for the lockdown is the 26th of April, and they're discussing if they're going to go until the middle of May. So as you can imagine, all classes have been cancelled, all schools have been cancelled, and therefore we are moving all the classes online. And GBSB Global has taken the decision for the rest of the semester. The spring semester will be online. And because of this historically unique event, I wanted today to give you an overview of the crisis and the implications for businesses, for finance, and also for governments around the world, and what this means, and what actions are they taking now to prevent economic damage to all the economies of the world. So I would like to start with, and I have some slides which I'm going to share with you after the presentation. Unfortunately, with using Facebook, I cannot share with you the slides right now, but as I say, you will have them as soon as I finish the presentation. And I would like us to go back to the 5th of January, which was not so long ago. And on the 5th of January, there was no cases of coronavirus in the world. And the first cases started to appear in China, as you know, and China started gradually getting more and more cases, because what's unique about this is that, first of all, it was unexpected. And then secondly, it is historically, we have never had a virus so contagious, okay? And it's not that many people die compared to other diseases. The problem is that this particular virus is very, very contagious, and it spreads enormously, quickly, very, very rapidly, in terms of doubling the numbers of people infected every week. So what did we see in China was that very, very quickly, on the 23rd of January, they locked down the region of Wuhan. And what did we see there? So the first economic indicators was that for example, it was during the Chinese New Year, and people from all over the world were going back to China to visit their families and traveling within China. And the first thing we stopped was people stopped taking trains and stopped taking planes within China. The second factor we saw was that no one was going on the metro, the public buses, and no one was going to the cinema. So all places where the public met completely had a sudden stop. As the data came out, all governments of the world were particularly concerned, and they were concerned about the validity of the information of China. And one way of finding this out, and what economists use and what people in the financial markets use, is to use the data from NASA, the satellites from NASA, and we could see images from those satellites that production started to stop in China, and therefore there was less pollution in the atmosphere. And from the satellites in space, we could see a great reduction in the emissions of CO2 gases. So we could see that every day from the 23rd of January onwards, there was less and less pollution in China, and particularly in the region of Wuhan. And therefore, this confirmed to us that this was a very, very serious case. And by the 1 month later, by the 22nd of February, basically there was no pollution coming out, no CO2 gases coming out of this particular region. And then on the 31st of January, all of China was put on lockdown. Okay, so therefore people had to stay at home and couldn't go out, and therefore this was also a fantastic measure that showed us that we could stop the spread of the virus by lockdowns. As I said before, the data that we have is that only 1% of the people die from this disease, and it is mostly elderly people. I believe the average age of the deaths are around 83 years of age. So this is the data we had initially coming out of China, that this virus was very, very contagious, and approximately 1% of the people affected, okay, will die, and most of those people will be the elderly. On the 25th of February, the virus had spread to Italy, and in particular to Milan and Bergamo in the north of Italy, which had quite strong local Chinese populations. And due to the different industries, there was commercial industrial relations between the north of Italy and China, and therefore it started to spread in Italy. And by March 6th, it had spread over all of the north of Italy, and by March 18th, it had spread to the whole island. Even there was cases in Sicily. So Italy became the country most affected after China. So at this stage, the stock markets, when we want to see the particular reaction to the first thing to react is the stock market indexes all around the world. Because we live in a globalized world and there's global supply chains, when we want to see what is happening, usually the first ones who have the best information are the ones who specialize in investing in the stock market, and it's the most sensitive indicator that we have. So between the end of February and the middle of March, all the major stock markets in the world, for example, the Japanese index, the Nikkei, fell by over 28%. The Dow Jones in the US fell by 31%, and the FTSE 100, the largest 100 companies in the world, fell by 34%. So we were seeing a sudden stop, that the investors were selling shares in the largest companies of the world, and there was very few buyers of these shares, and therefore there was this tremendous historic drop in the stock market. If we look at in all over the world about people between this period starting around the 1st of March, and we look at the number of reservations at restaurants compared to 2019, the restaurant reservations had dropped by 82% in the UK, 84% in the US, 86% in Ireland, 90% in Germany, and 94% in Canada. So we can see that the vast majority of people stopped going to restaurants. The next index that's interesting to look at is called the Purchasing Managers Index. And this is what the companies all have buyers, and these buyers purchase the raw materials that go into their business. And they usually do this 3 or 4 months in advance. If you're McDonald's, you start ordering your potatoes, your burger buns to have a supply for 3 months in advance. And we can see in all these indexes around the world, the purchasing managers stop buying goods. Zara, for example, stopped buying goods, and at that moment, at the beginning of middle of February, end of March, they had over 300 million worth of goods in the supply chains that were coming to their stores, but all their stores was closed. So therefore, they've had to write off all this stock. So this purchasing managers, obviously at Zara and McDonald's and the other leading companies of the world, just stopped buying at that moment in time. And the supply chain froze. And we can see this if you look at the Purchasing Managers Index. That leads us to looking at the prices of commodities. If we look at copper, nickel, aluminium, zinc, lead, soybeans, all the ingredients that we need to make products also had a sudden stop, and the prices of those products all dropped dramatically. The commodity that dropped the most was oil, because our universe and our factories all run on oil. So also this is immediately shock to the oil price. And the oil price dropped from around over $60 to close to $20 in a period of 3 weeks. When investors see this, what do investors want to do? Investors in this economic crisis and all economic crises want safety. What are the most safest assets in the world? The most safest asset in the world is the US dollar, okay? Even if you live in Europe, if you live in Japan, in any crisis, historically, the dollar always rises, okay? And if we take a number of countries that are less developed than Europe and Japan, like Mexico, like Russia, like any country in Africa, okay, the local citizens, the local investors want to move their money out of their local currencies and into dollars. So we can see that when we have a crisis, people move their money. They sell risky assets, okay, like restaurants, airplane companies, etc., 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 cruise ship companies. They sell, and what do they buy? They buy US dollars. What do they normally do with those US dollars? They can keep them in cash because we have a cash crisis, that people need money to pay their suppliers, to pay their employees, and the dollar is always accepted, okay? For example, one case is of the Mexican peso, and the Mexican peso dropped around 20-30% against the US dollar. So people rush to buy dollars. Then what do they do with those dollars? If they want to invest in the financial markets, they move their money out of equities, out of stocks. As we saw before, the US stock market, the Japanese stock market, the European stock markets are falling. And what they will do, they will buy US Treasury bonds. because US Treasury bonds guarantee you, okay, that you will be paid. And when we invest in Treasury bonds, in government bonds, what we really want to know is what is the possibilities that a government will default on its debt. Okay, so this year, a number of countries like Argentina, Lebanon, defaulted on their debt, and they explained to the investors in the government bonds of those countries that they could only pay back, let's say, 60% of that debt. But the US Treasury bonds is the safest investment in the world, and they never have defaulted in the last 30, 40 years. And therefore, they promise they will give you back your money. And you will gain a little bit of money on the interest of that bond. But you will get 100% of your money back if you buy a two-year bond, a 10-year bond, a 30-year bond. So your money is safe there. The correlation with that is in a crisis is that the interest on that bond, because so many investors want to be in dollars and they want to buy US bonds, US government bonds, the interest rate basically goes down to close to zero. So you maintain your capital, but you get very little interest on your bond. So those are the movements in the financial markets around the world, okay? And what also happens is that people also invest in gold, because in a crisis, gold is a very, very important asset. It's not as safe as dollars. It's not as safe as the US Treasury bond, but it tends to increase in value when we do have a crisis. So at this situation, what do the central banks do? Okay, so everybody is running to cash. Everybody is running to safe assets and is taking their money out of risky assets. So what do the central banks do? The central banks basically reduce interest rates to zero. Because at this stage, what happens is that usually interest rates on risky assets, when business people go to the bank and they want a loan during this period, the bankers are very nervous about lending to companies, and they tend to increase the interest rate. So to stop this process of that business people can only borrow at very, very high rates, the central bank reduces interest rates to zero, and they also lend enormous amount of money to the banks. So therefore the banks have an excess supply of money, and therefore they can increase the number of loans to big, small, and medium-sized companies all around the world, because we do not want a credit crisis, okay, and a lack of liquidity in the market. So the central bank is the lender of last resort to lend to the banks that can keep on lending to the real economy and can extend their loans. Try to think of a restaurant owner. The restaurant owner has to keep paying rent, has to pay back mortgages, has to pay suppliers, has to pay employees, and therefore they need to be able to borrow at very low interest rates during the crisis period, because we know the crisis period will last between 2 or 3 months historically, and therefore they need low interest rate loans during this particular period. So the role of the central bank is to be the lender of the last resort and lend money to the banks so they can lend to the real economy. So that's what the central bank does initially. When that doesn't work, what do? They do quantitative easing, okay? The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, all the central banks, they start to buy those risky assets. Since no one will buy risky assets, okay, like mortgage-backed securities, like shares in big companies, the central bank will use its balance sheet, it will print money, and it will buy government bonds, it will buy every type of asset to correct the problem of lack of liquidity in the marketplace. So that's the role of the central bank, to be the lender of last resort and inject liquidity into the markets. It will also print dollars, and it will lend those dollars to the other central banks so they can lend to their companies. Because, for example, when we want to buy oil, oil is priced in dollars. So every country in the world needs dollars to be able to buy products and commodities on the international markets. So this will have the effect of that the dollar will rise, but it will not rise to extreme levels and will not be scarce, because during this period, this Federal Reserve will print lots of dollars, lend them to the other central banks of the world. The other central bank of the world will lend them to the banks, and then the banks will then lend them to the companies. So then we have the situation that what does the government do? When we have interest rates at zero and the economy is not stimulated, okay, is not growing, and as we see in this crisis, GDP growth during this particular quarter of these months will fall by an historic level of 30%, then what we need is the governments to go in and to act to stimulate the economy. And what is important of this particular period? As we said before, the large companies, McDonald's, Boeing, the airline companies, the banks know they will have a business when the crisis is over and will lend to them. But here we have a problem that banks find it difficult to lend to small companies and to self-employed people who are in, let's say, in the gig economy. And also, we have to give some aid to employees. So the two unique programs that we have now, one is called paid protection. So the scheme in Europe is that the companies say to their workers, we're going to close down for 3 months, and the government is going to pay you 75% of your salary while you're locked down at home. And we promise to rehire you after the 3 months once we can open up our business again. So this is called payment protection. Okay, it started in Germany. The idea was a German idea during the last crisis to protect the wages of the workers while we were in a period of crisis and the factories were not working. And this has been extended all around Europe, because within Europe we have a social safety net, and we have unemployment benefits, and we have extensive services of free healthcare, etc., etc., etc. In the United States, they do not have an extensive social safety net. So you may have heard and listened to that the US government is going to send people of checks of $1,000 or $1,500 during this particular period. So that's the payment protection schemes. The next scheme is for the self-employed or the small business people, and the government will ensure that they will give money to banks in a particular program, and they will guarantee the loans. So if the small businesses go bankrupt in the future, the government will pay back these loans. So to protect the economy going forward, their government is focusing on using fiscal policy, okay, to help those people in terms of payment protection and those small enterprises in terms of making sure they have income and they have loans during this period of economic distress. The data that we have now is that the number of cases in China have dropped dramatically. I believe this week there has been no new cases. If we look at Italy, the number of cases due to the severe lockdowns in Italy have been reduced. In Spain this week, the number of deaths, although the number of people getting the disease is still increasing, the number of deaths is decreasing. A few days ago it was 900 per day, then it went to 800, and now it's close to 700 per day. So we can see that the measures that we're using in terms of lockdown are working, and all governments are hoping that in May we can slowly, little by little, go back to normal business. This week, countries like Denmark and Austria and the Czech Republic are opening up from severe lockdowns to letting more and more companies, okay, go back to business and giving more and more freedom to people to go out under less strict conditions. So we predict that starting in June, little by little, the businesses are going back to open up, and people will go back to work little by little. And we will have to see if places like schools, cinemas, etc., will be able to be opened up, okay, from June onwards. As you've seen, massive events like the Olympic Games or the European football matches, okay, probably will not start up again till September, but that's the situation we're in now. Little by little, we are going to see it opening up, and therefore businesses can get back to work. If it's going to take about 6 months, then this means a massive amount of fiscal debt has been acquired by the governments of the world, and they have used this money to maintain and protect their businesses and the employees, but this can only happen for a certain period of time. So after the crisis, if it is 3 months or 6 months, all economic actors in society will have greater debts. And therefore, this means we will have, in terms of central banking, very, very low interest rates for a long period of time to ensure that all the economic actors can pay back their debts. But there will be, okay, a number of businesses who cannot even afford to stay in business. And there will be a number of countries like Spain and Italy with very high debt to GDP ratios. So this is the debate going on in Europe right now about what can we do at the European level, okay, to enable Italy and Spain to reduce their debts. So that's why all in the press right now, and there's a meeting today of the ministers of finance from all the European governments to discuss of how can we, as the European Union, help Italy and Spain in particular, those two countries mostly affected. We know they will have very high debts after the crisis, and how can we help them reduce those debts? So this is a very difficult, complex debate about how we can use all the resources in Europe to help, in particular, all countries, but in particular Spain and Italy, to reduce their debts as we go forward, looking to the next 10 years. If Italy and Spain and all countries in the world have very high debts, it means we will not have strong economic growth. And without strong economic growth, our companies won't grow, they will not hire people, and therefore this is the big long-term challenge, is how do we pay for all these fiscal measures going forward? So today I gave you an introduction to how the coronavirus started, and also what economic measures are being taken to tackle this particular crisis. So now I would like to open up a question and answer session, and you can ask me any questions that you would like in the chat box, and I will answer them. So I have a question from Diego, and Diego's asking me, is it a good opportunity? And I think that it's a very good opportunity for entrepreneurs, especially young entrepreneurs who have not started their businesses yet, or their businesses are very, very small, and they don't have much debt, and they don't have many employees, because I do think that many, many businesses are going to go bankrupt, okay, in the next 1 or 2 years. So therefore, if you're starting a business and you're competing in a sector whereby your competitors have a lot of debt and you have no debt, then you have a competitive advantage in that particular marketplace. Frederick Baumann has asked me, what about the situation with inflation? Okay, so in the past, according to Milton Friedman, that inflation was a monetary phenomenon, that if we print money, it automatically leads to inflation. Okay, so, but in the last 20 years, this has been proven to be wrong, because what's happened is that even though we print money, and there's a lot of dollars in the system, okay, what happens is that these dollars are basically used to pay back debt. When we have a lot of debt, households, families, companies want to pay back their debt, and when we pay back out debts, money is created by banks giving loans, and when individuals, families, companies, businesses pay back their debt, therefore the money is taken out of the system. So we are going to see in the next 10 years is going to be 10 years of deleveraging, which means reducing debt. Governments are going to reduce debt, business is going to reduce debt, and therefore the fear is not galloping inflation, it is deflation. Okay, another one student has asked me about gold, and yes, gold is a good investment when we have a crisis. When the economy goes well, the price of gold tends to reduce. So therefore, if you're pessimistic about the future, and if you see that in the numbers of the contagious virus goes all around the world, and we see that, for example, in the United States, that the number of people getting this disease is not going down, then this tragically is very, very good for gold. So what happens is that gold is a safe asset, and it is very good in a crisis. So it depends upon whether you're optimistic that we will be able to conquer this virus, that we will be able to stop contagion, stop deaths, and therefore people can go back to work. If you feel optimistic about this, don't buy gold. If you're pessimistic, then the good idea is to buy gold. Gold will increase in value under a pessimistic economic situation. Also, Tony Seaman has written in the chat explaining that the government of Canada is going to give people $2,000. So this is a very good payment protection scheme, and Canada can afford to this because Canada is unique. Canada is a very large country with a lot of resources, and it has very few people, and therefore the per capita incomes are very, very high, and also Canada can afford to do this. So those countries that are rich with small populations like Norway can afford to be more generous than the other populations. So I have a question about Barcelona, and yes, in Barcelona, obviously it is the number one industry is tourism. It is the biggest industry is hospitality in terms of bars, restaurants, discotheques, and they will be greatly affected. Okay, and unfortunately here I am pessimistic to think that a lot of these companies that run the restaurants, which are basically small businesses, have taken on debt, and these businesses like discotheques will be one of the last businesses to open up. So those very big restaurants in Barcelona on Paseo de Gracia will have a very difficult economic time. In this period, they are not making any money. They have to pay their rent. They have to keep their employees, keep their suppliers. They have to pay their debts, and they have to keep on their debts. So there will be a number of businesses that will not survive, and there will be new businesses that start up without debts, and compete against them and have a financial competitive advantage due to the situation. So a number of restaurants will close down, but a number of restaurants will open up, and therefore in a year or two's time, when the economy is back up running and back to normal, there will be enormous opportunities because even those businesses with debts, they will have to increase their prices. Jules has asked me which industries have been the most affected. So the ones that are most affected in the beginning are transport. So if we look at cruise ships, okay, there's a question of whether we should give money to cruise ships industry, whether it's an important industry or not. And I think that people will be very, very reluctant this summer or maybe next summer to go on a cruise ship. Because of the close proximity to the people, that you're locked in the middle of the sea into a small space with 1,000 people on a ship. This is the perfect environment for viruses. So cruise ships, then airplanes. I consider that a number of airplanes will go out of business. Ryanair is the largest airline in Europe. So if we take some of the weaker ones like Air Italia, if they're not belong to a big group, then what will happen is that the airlines could go bust. Then we take a step back and we see the situation with Boeing and Airbus. Both of them will need enormous amount of funds from the government, but since they're strategic industries, and both Airbus and Boeing have defense industries, make military equipment, they will be saved and bailed out by the government. So the ones most affected in terms of transport, in terms of tourism, cruise industries, hotels, restaurants, cinemas, and those businesses may not be bailed out by the government because they may be not considered essential for the economy. So Philip has asked about Eurobonds. So the debate today that's going on between the presidents of all the European countries and the finance ministers is the fact that Eurobonds mutualize the debt. So we have instruments from the European Central Bank to give enough liquidity to governments and to banks as a lender of last resort. And we also have the economic stability mechanism that will lend to countries. Normally, what happens is when your country has high debts, if you're not within the European Union, you have the possibility where the IMF, the International Monetary Fund, will lend you money, okay, when no one else will lend you money. And in the case of Europe, we've the ESM, the European Stability Mechanism, will lend you money. But when you borrow money, okay, there's always conditions attached. So in the case of Italy, what happens is that Italy has a very generous pension system, and Italy, the government of Italy, is afraid that if it borrows money from the European Stability Mechanism, they will say you have to increase taxes, you have to reduce pensions, and all these terms that makes governments very unpopular. So what happens is that the Italian government and the Spanish government don't want to borrow money in the future from the European Stability Mechanism. What they want is Eurobonds. When we have Eurobonds, the 27 countries of the European Union all borrow together on the financial markets, and all 27 countries pay back this debt, okay? So therefore, the debts of all the countries are shared together. And therefore, this is one way it would make that the debt for Spain and Italy would be much cheaper, but to pay back, and they would have much less debt. But then who is paying for this? This debt is shared out between all the other countries. And there are other countries in Europe that are poorer than Spain and Italy. So Poland is poorer, Latvia is poorer, Bulgaria is poorer, etc., etc. So therefore, this is a very problematic issue of Eurobonds, of mutualizing the debt over a number of countries. Right now, 9 countries of the 27 are in favor of Eurobonds, but the vast majority of the countries are not in favor. The vast majority of countries want Spain and Italy to borrow from the European Stability Mechanism. And as of today, Spain and Italy have refused to borrow from this mechanism. So right now we're in a point of negotiations where neither side is giving way, but this conflict will have to be resolved in the next few weeks, and therefore please follow the newspapers to find out what way the leaders of Europe can get a compromise between Eurobonds and the European Stability Mechanism in terms of lending money. And Jonathan asked me, is there a lack of cohesion in terms of lending money? And I don't think so, because if you look at what we have different institutions within Europe. So the European Central Bank is doing a fantastic job of lending to all countries, and we can see that in terms of Italian bonds and Spanish bonds, that they can borrow at very, very low money. So the European Central Bank is doing its job. The European Commission has a budget which is, even though it's only 1% of the GDP of the European Union, it's a small budget, but it also is helping. And then we have other institutions like the European Investment Bank that can borrow money in the markets and lend to companies. So the only situation is that whether we should do Eurobonds or not. The fact that we don't do Eurobonds doesn't mean that the European Union is not working. It doesn't mean that the countries are not generous, that we're not working together. It's just a very important step, if we do it, okay, to share the debt, okay? So right now, Spain and Italy have no problem, and they have the fiscal capacity to borrow as much money as they need, okay? But with this money, they would have to pay the interest rates, which I explained before, are very low, around 1%. But another step is whether they can mutualize this debt. So that's what's under debate today. So there is tremendous help and cohesion within Europe. It's just if we should take this big step forward. And this big step forward means creating a new institution. Maybe it means having referendums. It means having a new treaty. So therefore, this is why this step is so important. So they asked me again about the travel and the tourism sector. So this will be a very difficult sector because in travel and tourism, you employ a lot of people. You have very low margins in restaurants and hotels for the mass majority of them. So therefore, the key factor here is to borrow money, okay, at low interest rates. So if they can do that and business comes back next summer, but if people don't travel this summer, then obviously the hotels, the restaurants all around the world will be greatly affected. So Martin asked me about Eastern European currencies. And yes, here, as we explained before, when we look at the world, the strongest currency is the dollar, then the euro, the Swiss franc, and the Japanese yen. And these currencies will stay strong, but the other ones in Eastern Europe, their currencies will fall during the crisis. Because, as I said, the rich people, the investors from these countries will want to move their money into euros and into dollars. And therefore, we have a natural movement towards the safe ones. So the Eastern European countries will recuperate once, okay, the crisis is over. Tiffan has asked me about Brexit. So I think that Brexit will be delayed, but the situation is that it is not good for the UK right now to make major changes in their economic arrangements because, as I said before, the economy has stopped. There's difficulty with supply chains. And if we add on new tariffs to goods coming and forth and services between Europe and the UK, it is not the time. So I predict that Brexit will be postponed until we get over this particular crisis, because Brexit is an economic shock to the European Union and in particular to Great Britain, which will be the country most affected by Brexit. So I would like to thank you all very much for attending the webinar today and for participating in sending me so many messages through chat. I wish you all the best, and I look forward to seeing you. Hopefully we can have a wonderful graduation in Barcelona this summer, and we can all get together and to celebrate. In the meantime, all my colleagues at GBSB Global, all my professor friends are working as hard as we can to put our classes online and to have a wonderful semester with you starting next week. In the meantime, I wish you all a very, very happy Easter, and I look forward to seeing you soon.